Welcome back to the vlog. We are going to start a new book today, and it is this book. This is Technical Analysis for Dummies. And I thought that this was the most relevant thing that I could personally start reading in terms of improvement for day trading, because I am a technical analysis trader. It is the basis, it's the foundation of my trading. So if there's anything that's going to make me better, aside from like just general mindset, I think it's going to be understanding technical analysis better and giving myself more strategies to be able to utilize in the market. Anyway, so I'm hoping this will help me reach new heights in trading, and hopefully you'll be able to benefit from that as well. It's Technical Analysis for Dummies, 4th edition, by Barbara Rockefeller. All right, cool. So let's jump into it. So in this part, find out what technical analysis is and isn't. Technical analysis bypasses, hold on. It's just loud. It's just always loud for whatever reason. Okay. In this part, find out what technical analysis is and isn't. Technical analysis bypasses fundamentals to make trading decisions on indicators that reveal market sentiment. Understand supply and demand. Securities trading deals with two forms of supply and demand, the old-fashioned kind and auction style. You want to join the trading crowd to take advantage of momentum, but very carefully without going overboard. Appreciate that indicators work most of the time because of the law of large numbers, but not always, and that's because the market is made up of humans who behave irrationally sometimes. Check out sentiment indicators and some useful measurement methods to get an overview of the trading environment, especially volume as an indicator of what the crowd is doing, as contrasted with what they might be saying. Protect your capital from random moves and from manias and panics by managing the trade from entry to exit, including exits that mean you'll be taking a loss. All trading involves taking losses, and the secret of success lies in controlling them. Okay, Chapter 1, Introducing Technical Analysis. Technical analysis is the study of price behavior in financial markets in order to forecast the next price movement and to trade on that forecast with cold, hard cash. Focusing on price behavior gives you a window into the mind of the market, with the majority of key players, or what the majority of key players are thinking, and helps you make better trading decisions. Technical analysis seeks to identify and measure market sentiment, described as optimistic or bullish, pessimistic as bearish, or uncertain about the future price, sideways range trading. So you need to figure out how to draw lines on your security price chart and work up the courage to place the buy or sell order with your broker. Each type of line is named an indicator, and I cover every majority type of indicator in this book. You need to figure out whether the line/indicator embodies a bullish or bearish outlook, price rising or falling. Many lines or indicators contain a handy built-in buy and sell signal, but following those probably won't match your risk appetite given the amount of capital you have. In practice, you'll use a computer program to draw the lines and to do whatever math underlies the lines. You'll also have many books and websites to guide you in deciding which lines to draw. Knowing how to draw lines is relatively easy. Placing the trades is hard. This is because your technical-based buy-sell decisions don't come packaged with how much to trade, how long to hold, how much risk to take, or even how much risk is involved. Finding the origins of technical analysis. Technical analysis isn't some new fingered flash in the pan. Observing prices and shutting out other noise has been in development for more than a century. Charles Dow, one of the founders of the Wall Street Journal, observed around the 20th century that the price of a security neatly cuts through all the clutter of words and is one piece of hand information you can trust, no matter what the other facts about a security and what people are saying about it. Here's some basic observations underlying technical analysis that are attributed to Dow himself. Securities prices move in trends much of the time. Trends can be identified with patterns that you see repeatedly, which I cover in Chapter 9. and with support and resistance trend lines, see Chapter 10. Primary trends lasting months or years are punctuated by secondary movements lasting weeks or months, in the opposite direction of the primary trend. Secondary trends, today called retracements, are the very devil to deal with as a trader. The trends remain in place until some major event comes along to stop them. These ideas are part of what is called the Dow theory. Along with Charles Dow himself, he called it that, and many ideas are called Dow theory that would surprise Dow. An internet search of the phrase Dow theory yields 23 million hits. A key point is that traders were using technical ideas long before the advent of electronic communication and software programs. Technical analysis is hardly a gimmicky fad that will have a short shelf life. Building on Dow theory were Robert D. Edwards and John Magee, whose technical analysis of stock trends, St. Lucie Press, was the first major book to use the term technical analysis in the title. It was published in 1948 and has been in print ever since. Edwards and Magee expanded on Dow's observation, covering many of the core concepts of technical analysis, such as support and resistance, breakouts, retracements, mini patterns, and more. Edwards and Magee noted the universal pattern of a primary up move followed by a shallower secondary pullback and then another up move. You'll see this configuration repeatedly as you explore technical analysis. Edwards and Magee were the first to introduce the tools still in use today to evaluate the pattern and to trade it profitably. What's different from Dow's day and Edwards and Magee's day is the advent of computers that take drawing lines and calculating indicators away from paper and colored pencils to a screen and cursors. Something else that differs from Dow's day is the continuous incursion of the scientific method into everyday life. At the turn of the last century, the scientific method was confined to scientists. Regular people would take a homemade folk remedy for a malady because their grandma swore by it. Today, the average person wants to know if that remedy was scientifically tested in double-blind tests and the results peer-reviewed. The comparable development in technical analysis is to take an observation about market prices and volume to test what percentage of the time the observation results in a correct deduction. To help you start, this chapter provides an overview to this book and what you can expect considering you're jumping broad into this book and the world of technical analysis. So, stepping up to science. It may be hard to consider drawing lines on a chart as scientific in any sense of the word, but it's through the scientific method that scientists can forecast outcomes in the physical world, and through the scientific method that you can forecast price outcomes in financial markets. Technical analysis of securities prices follows the scientific method in that it entails systematic observation of the subject with standard measurement methods to form hypotheses and then testing the hypothesis many times to validate the theory. But there's a problem. In a hard science like fluid dynamics, the thing being observed and measured is an object, in this case, water. In technical analysis, the thing being measured isn't hard. It's market sentiment generated by human beings who have far more variability than physical objects. Even given human variability, market sentiment tends to move in repetitive and predictable ways. Technical analysis gives you the tools to identify which sentiment the market has on display at any one time. Today's technical analysis has a wider understanding and appreciation of statistics and probability, and thus the value and pitfalls of forecasting. The theory of probability originated in the 16th and 17th centuries, but dealt mostly with the outcome of games and thus the best way to bet on games. Not until the 1920s and 1930s did statistics and probability enter the general public mainstream. Today, even ordinary people routinely ask health questions of their doctors in probability terms, such as, what percentage of small children with the measles vaccination does it take for the rest of the school class to risk a measles outbreak? Throughout this book, I use words like highly likely and forecast. I say, for example, technical analysis use lines and indicators to identify price moves that provide a fairly reliable forecast of upcoming future price moves. The word forecast makes everybody squeamish because everyone knows stories of catastrophically bad ones. History is full of them, like a top economist saying in 1929 that the stock market was in the fine fettle just before the crash. Don't be misled. Although the word is riddled with negative implications, everyone makes forecasts all the time. They just don't think of them as forecasts. In fact, you make forecasts many times every day. You take this travel route over some other route because you forecast it will save time or aggravation. On a larger scale, when you move to a new city, take a new job, get married, have children, or buy a house, you're making a forecast about the outcome. Every life decision you make is a forecast, a bet, almost always made on incomplete or hidden information. Technical analysis entails forecasting, but don't let that scare you. You'll have plenty of data in dozens of formats to help you, and I describe nearly all of them in this book. Unpacking lingo. To get you started, most of the vocabulary associated with technical analysis that you need to know you can learn in grade school. Here is a list of some of the important lingo to know. Chart. Chart is the workspace of technical analysis is a chart. Much of the time, the chart will show some time along the horizontal axis and price along vertical axis, but not always. Some charts are formed differently, as I discussed in chapter 14. Bar. The price information on the chart is presented in several different formats, but usually you'll see each period's price as a standard bar showing the price open, high, low, and close. Refer to chapter 6 for more about the bars. Bars, or a series of bars, can be used alone to detect patterns that reveal how participants in the market feel about the security and therefore what might happen next to the price. Candlesticks. Another method of showing the same information that the bar does is the candlestick bar. And lines. Drawing lines on the chart helps forecast future prices. For example, you may draw a line connecting a series of price lows, and name it support, meaning you expect the traders in this security will see the next low as a buying opportunity, raising the price again. And lastly, indicators. You want to enhance the information and the price data by arithmetic manipulation, creating indicators. Indicators come in all shapes and sizes. For example, you see a price chart where the price jumps all over the place. You have no idea whether to buy it or at what price. Now take an average of the closing price over the past 20 days to smooth out the price jumps. Does that line of averages point up or down? Aha! You may have identified a tradable trend. I describe a wide range of indicators in chapter 12, 13, and 14. Buy and hold is bunk. Yeah, all right. You may think that active trading is too much work and too uncertain to spend the time on. Why not just buy and hold? Buy and hold is a philosophy that says most equities are best left unattended for long periods of time in your portfolio. They'll rise more or less in sync with the overall economy so that avoiding turnover saves you transaction costs and taxes. Besides, who are you to suggest a security is over or undervalued? One reason to distrust buy and hold is that over really long periods, returns aren't very good at all. Stocks from 1950 to 2018 returned 11.1% annually. Bonds returned 5.8%. If you had a 50-50 stock and bond portfolio, you averaged 8.8%. The average return on the S&P 500 over the past 30 years is only about 8%. In order to get high returns, you had to pick one of the periods when the market was in a bull market phase. In the United States, from 1927 to 2018, the Standard & Poor's Equity Index has been in 25 bull market phases, meaning it rose more than 20%. Each one averaged about 3 years, and the average return of each of the bull markets was 127.36%. But the S&P also fell 20% or more, defined as a bear market, 25 times over that same period. Timing counts. In other words, to buy and hold securities for a long period of time is a well-documented path to accumulating capital, but only if you got in at the best time. Otherwise, buy and hold is a path to the poorhouse. Consider the following. If you had bought U.S. stocks at the price peak just ahead of the 1929 crash, it would have taken you more than 20 years to recover your initial capital. Since the end of World War II, the Dow Jones Industrial Average has fallen by more than 20% on 14 occasions. From January 2000 to October 2002, the S&P 500 fell by 50%. If you owned all the stocks in the S&P 500 and held them throughout the entire period, you lost 50% of your stake, which means you'd now need to make a gain equivalent to 100% of your remaining capital to get your money back. Ask yourself how often anyone makes a 100% return on investment. During the crash of 2018, the S&P fell 6.2% and the Dow 5.6%, the worst performance in a decade. During a year that saw the highest economic growth in a decade. That covers the factual aspect of buy and hold. You need to get lucky in your entry. Now consider the underlying assumption that all information is already incorporated into the price, that so-called efficient market hypothesis. Even if the weak form the argument, the assumption is patently untrue. For one thing, if markets were actually efficient, you shouldn't get bubbles and crashes, and yet undeniably they happen. Behavioral economists have found that prices are influenced by all kinds of bias, including overconfidence, wishful thinking, and the whole panoply of possible errors in both reasoning and in evaluating information that's not always unambiguous. Can you beat the market using timing over buy and hold? Yes. Timer Digest has tracked dozens of timers in gold bonds and equities who publish newsletters over the past 35 years. You can look for this at timerdigest.com. In 2018 alone, the S&P ex dividends fell 6.24%. The top 10 timers had gains ranging from 12.86% to 40.32%. Over the past 10 years, the S&P rose a cumulative 177%. The top timer had a return of 249%. The timers aren't getting one-time lucky. You see the same names over and over again. I really like this book already. This book is speaking my language. The emphasis in technical analysis is to make profits from trading, not to consider owning a security as some kind of savings vehicle. In buy and hold investing, you hardly ever sell, sometimes waiting until you have a catastrophic loss. In technical trading, when you sell is just as important as when you buy. Before diving into technical analysis first, you have to appreciate that it's the chart that determines the trading decision, not the underlying fundamentals of the security. You don't have to follow earnings, management style, new inventions and designs, or any other qualitative aspect of an equity security. In commodities, that might be the weather in Brazil or Chinese demand for rare metals. In foreign exchange, you can ignore inflation, GDP, and central bank forward guidance. You can still use fundamentals if you want to, although technical analysis is the central factor in the trading decision. It doesn't have to be the only factor. Many technical analysts use programs to winnow out the best candidates in a list of securities based on fundamentals like earnings, dominance in its sector, sales forecasts, dividends, and so on, and then apply technical analysis to select the few that remain. Fundamental analysis and technical analysis aren't enemies. They can be combined to complement one another. Recognizing who uses technical analysis. Both traders and investors use technical analysis. So what's the difference between a trader and an investor? Most people consider that a trader is someone who holds securities for only a short period of time, anywhere from a minute to a year. An investor is someone who holds securities from many months to forever. You may also think of an investor as someone who seeks income from dividends or bond coupon payments. Actually, the dividing line between trader and investor isn't fixed except for purpose of taxation. Be careful not to fall into the semantic trap of thinking that a trader is a wild-eyed speculator, while an investor is a respectable guy in a pinstripe suit. I use the word trader in this book, but don't let it distract you. People who consider themselves investors use technical methods too. You can use technical methods over any investment horizon, including the long term. If you're an expert in the blue widget stock, for example, you can use technical analysis to add to your holdings when the price is relatively low. Take some partial profit when the price is relatively high, and dump it all when it falls more than you can stomach. only to buy it back when it bottoms. Technical analysis has tools for identifying each of these situations. You can also use technical tools to rotate your capital among several securities, allocating more capital to the ones delivering the highest gains or the lowest risk. At the other end of the holding period spectrum, you can use technical analysis to spot high probability trades and execute the purchase and scale in 1 hour. Remembering the trend is your friend. You can look at most charts and see that securities prices tend to move in trends, and trends often persist for long periods of time. Opinion varies as to how long any specific security remains in trending mode. It may be 20% or it may be 80%. A trend is a discernible directional bias in the price, upwards, downwards, or sideways. Many people don't consider sideways a trend in its own right, but rather a departure from an upward or downward direction. And yet it can be useful to consider sideways a trend, because when you widen the time frame to include more time, you often see that a sideways move is a transition phase from one direction to the other, often on a sudden breakout. You gain an edge when you can forecast a change in direction, even if you don't know yet which way. The secret to successful trading is to buy at a low price and sell at a higher price. The chart displays lows and highs, and your charting work should indicate whether you can next buy low and sell high, or where you can next buy low and sell high. In these sections, I show a model for identifying trendness and how technical analysts use the model to make money. Charting your path. The price chart is the primary workspace of technical analysis. Many technical analysts work only with mathematical manipulation of prices in order to devise probabilistically optimum trades. In order to devise probabilistically optimum trades. But the chart is the starting point for nearly everyone and remains the main workspace for the majority. Figure 1-1 shows a classic uptrend following a downtrend. Not gonna lie, these drawings, these illustrations are a lot more clear than the previous book. Not that they knew anyone would be reading their book and showing the trend lines and everything and all these small details, in a reading vlog, but it's just nice. All right. At the most basic level, your goal as a technical trader is to sit on your hands while the security is falling and wait to identify the reversal point. The best place to buy, shown in the circle, as early as possible. Figure 1-1 is a good example of the kind of chart with which you'll spend most of your time. Unfortunately, most charts aren't as clear-cut as to the correct trading decision as this one. Aren't as clear-cut as to the correct trading decision as this one. Trendiness versus trendness. Trendiness versus trendedness. To say that something is on a trend is to say that it is moving in a specific direction and exhibits evidence of a tendency to continue in that same direction. The use of social media like Twitter and Facebook is a trend. What's the difference between trendiness and trendedness? Trendiness implies a fashion or fad that may wither and blow away like skinny jeans. Trendedness refers to a measurable directional bias. It is a more serious word reflecting a more serious and enduring phenomenon. Skinny jeans may be out of fashion 30 years from now, but social media will probably still be around and securities charts will still be exhibiting price trendedness. Skinny jeans may be out of... we just read that. Okay, becoming a quant. You don't need to know any math at all in order to use technical analysis. If the word algorithm makes you feel faint, fear not. It is enough to know the difference between big and small, up and down, black and white. Math is a shorthand method of expressing what non-math types, me included, put into words. For example, I may say the price is moving upward at a faster pace than before. The math person measures the exact extent of the up move in arithmetic terms such as momentum. He takes today's price and divides it by the price times number of days ago. He does this for 5 days in a row and gets a momentum indicator that is a higher number every day. Just because the math person has a number doesn't make his trading decision any more better than yours without the number. The observation of the price event is equally valid however you express it. You can use indicators that you put on a chart yourself from the charting program, broker platform, or website that lets you fool around with their indicators without knowing or caring about the math behind the indicator. Your job as a student of technical analysis is not to know exactly how an indicator is calculated arithmetically. It is to know whether the indicator is indicating. It is to know what the indicator is indicating and what decision the indicator is suggesting to you. Don't worry about finding a user-friendly program to do the math work for you. 20 years ago, both the data and the software were very expensive. Now they're a given. Do a web search of a free charting software and you get more than 4 million hits, including reviews of the program. Picking a time frame. You don't have to select a time frame right away. In fact, don't rush. You may fancy yourself a conservative person who would never want to join the ranks of those flibberty gibbet day traders. But the fact remains that day trading is a deeply risk-averse form of trading when properly executed, and your position on life's time scale can be important too. You can't day trade when you have a day job, but you can when you're retired or are temporarily out of work. I know of one auto company president, who got through a rough patch, meaning unemployed, by day trading. Complicating your decision about what time frame to trade is the weird and wonderful aspect of market prices, named their fractal property. Fractal refers to the odd fact that a price chart of a security on a 1 hour time frame basis can't be told apart from the price chart on a 4 hour time frame or daily time frame or even weekly. If the chart isn't labeled along the bottom horizontal x-axis to disclose its period, you can analyze it using any indicator and get the same outcome as you would get on any other time frame. Viewing the scope of technical analysis. Technical analysis focuses on prices and often the accompanying volume. Analyzing prices can take many different forms, from drawing lines on a chart by hand to using high-powered computer software to calculate the most likely path of a price out of all possible paths. Technical analysis is sometimes called by other names such as charting, market timing, and trend following. The press, the public, and even technical analysts, authors all use these terms interchangeably. All technical analysis methods fall under the broad term quantitative analysis to set it apart from fundamental analysis. When you see these terms in the book and elsewhere, don't fret over a strict interpretation, and don't accept or reject technical ideas because it has a particular label. You can put 10 technical traders in a room and get 10 definitions of each term. The following sections are my interpretation of these terms and their nuances. So that concludes half of this chapter. The chapter is kind of long and it's pretty detailed, and I'm excited as AF about that. So, but we'll stop right here, and then the next vlog we'll read the second half of the chapter. I'm pretty excited. I'm pretty into it. I'm gonna nerd the fuck out on this book. So hopefully you join me, and I will see you guys next time for the second half of this chapter. All right, peace.